the ultra high net worth space is not even a debate in my mind. Like, I mean, if you look at where most of the family office or multifamily offices are out there, they are in the RIA space.
What's new on the NewEdge wealth side?
They are crushing it. Again, kind of going back to what you can do for ultra high net worth clients in this space is just so much more differentiating. And it helps advisors at NewEdge Wealth win clients. Their win rate is crazy relative to when they're going against people from wirehouses or other places. You just can't get that in the cookie cutter wirehouse world. They're trying. Whatever you get in the wirehouse world is the watered down, commoditized, basically menu. What you can get in the RA space is so much more unique and differentiating. It's really, once you start to dig in, it's not even really a comparison. It's just night and day difference. A large percentage of wirehouse advisors, because that's what they're being told by their firms, have a misconception that there's a lack of fill in the blank outside of the wirehouse. And it's the opposite. There's more of fill in the blank outside of the wirehouses. Right now, the M&A space continues to be a story for everybody. And if you're not in it, you're kind of not even playing in the game at the moment. 100 billion sounds like big right now, but that's not really big. 3 or 5 years from now, it's going to be 500, and you're just going to continue to see this grow and evolve in a serious way. And the light bulb moment for me and for a lot of advisors is when I was leaving Wells, thinking like, oh, Wells has everything, and I'm going to take a step back. And then you go to these custodial partners, you look at what the Fidelity, Schwab, Goldman's, LPLs, Raymond James of the world have to offer. I mean, it's everything and anything. Think about what an average individual investor has access to when they open their own personal Schwab account. I'd argue they have more access as a direct Schwab, Fidelity investor than most advisors have, at the big wires.
Hey everyone, thank you so much for coming on the podcast today. Today we have Alex Goss as a guest. He is the co-CEO of NewEdge Advisors, one of the largest and fastest growing RIAs in the industry. And I got this offline. I'm sorry if I messed this up, Alex, but the NewEdge Capital Group, as of the end of 2024, exceeded $65 billion in assets under management. And today, we just plan on talking about the RIA space in general, what Alex is seeing out there in the marketplace, being in it day in and day out, and what is new at NewEdge. Alex, I really appreciate you coming on today.
Yeah, thanks, Corey. Good to do this again, and always fun catching up with you.
Yeah. Did I nail that 65 billion at the end of the year? Was that right?
Yeah, it was, and it's a lot higher now. But,
I love it. I love it.
It's been a fun ride, for sure.
I love it. So it was almost a year ago until the day we had a conversation last time, just talking about the RIA space, what's been going on at NewEdge. Before we get started, in terms of talking about the marketplace, what's new at NewEdge as a whole?
Yeah, I mean it's like I was saying. I mean, it's been a fun ride. I mean, NewEdge really, if you think about it, it was three companies kind of came together in 2020. You had Mid-Atlantic, Turnstone, which was run by Rob Sechan, and then Goss Advisors, all kind of merged together and became what is now NewEdge. So, that was 5 years ago. So, early on there was a lot of like merger and technical work that went into that. But the evolution of the company has gotten to a place that I'm just, Rob and I are just incredibly proud of. Basically, you have a firm that is built for elite financial advisors that have a long career track record. That's kind of where we sit, right? And whether you need resources to support ultra high net worth clients, or you kind of have the resources you need in-house and you just need more resources to help support your own efforts, we've got a home for you. So it's been, really, it took a lot of work to build this company to where it is. And now, you're really seeing kind of both sides of the house work together too, because we've got a lot of advisors that focus on that kind of 2 to 10 space, but they often have a 10 that turns into a 50 or 100, and then they'll go work with the ultra high net worth space to help close that business and, keep it together. So it's been neat to see, the cultures really merge and come together as one company. And, it's just really, it's NewEdge now. And, really the common denominator is, we're just a home for Arrive, the lead advisors. And we're trying to build everything that elite advisors need to kind of continue to be successful and really get to that next level.
That's awesome. And we dug into the value proposition pretty deeply on the last podcast that we did, if anyone wants to, check that out. But one thing I've been really surprised about, Alex, both on the NewEdge Wealth side and the NewEdge Advisor side, I would have thought that when we first started talking about your value proposition, you would have like mainly been a landing spot for wirehouse advisors. But I mean, independent advisors as well have been just as excited about your platform from the feedback that I've been getting.
Yeah, it's been independent advisors, existing RIAs, has spiked tremendously over the last 24 months. And I'll say that wirehouse advisors have increased too, because I think, I'm sure as we'll talk about this piece of the or channel of the financial advisor ecosphere has really, I think it's no longer, a validation question. I mean, it is a validated channel, and you're starting to see a lot more movement and interest from what you would call the kind of corner office advisors or wirehouses making the move.
Yeah, it's been absolutely crazy, the growth in the RIA space. I mean, I explore the industry 40 plus hours a week. On my team, there's 15 other consultants across the country. And every week we're kind of connecting and talking about new opportunities that are out there. And us being in the industry nonstop, it's almost hard to keep track of them all. I mean, there's been a huge pattern, especially in the wirehouse side, of one thing I've seen, just people in wirehouse leadership that probably never would have thought in a million years they would have made a move to, the RIA space, are now going out and investing and launching their own firms. You have David Koak from the CEO of Wells Fargo Advisors launching Ampersand, Jim Dixon doing Indivisible Partners, and even inside of NewEdge. I know you have some investors that were really deep in the lineage inside of UBS. What else are you seeing out there in the RIA space?
Yeah, I mean, Bob McCann is our co-chairman. He was the CEO of UBS and Merrill Lynch, right? And as an investor and co-chairman. So, no, wirehouses aren't bad, right? Like, I think a lot of financial advisors started their careers there. They really felt like the wirehouses were a great place to grow, their businesses. And there was a time where advisors really felt that wirehouses cared about the end advisor, and and felt that the advisor client relationship was the most important part of the whole relationship. I think that just switched, right? And a lot of the, really post '08, you have a predominantly international bank owned wirehouse, uh, you know, group of firms, and the view has just shifted to be more, it's about the firm and what the firm can do for the client, and the advisor in a lot of ways is an annoyance to the firm. So the leadership that you're seeing join and start these other firms are kind of the old guard, right? It's the leadership from when the wirehouses really cared about the end advisor and the end client, and they're just, the ones that have left recently are leaving for the same reason advisors are leaving. They're fed up and they're kind of broken, tired of dealing with, the nonsense.
So when you're digging in with wirehouse advisors and they're exploring your platform, what are some of I still feel like there's a misconception out there, even though there is the validation of corner office advisors making the move to a firm like NewEdge. There's leadership leaving and helping launch or being in a big leadership position inside of these RIAs. I still think there's some wirehouse advisors out there that feel like they're potentially taking a step back in like technology or ultra high net worth capabilities. And it's very much a misconception. But when people are exploring the firm, like what are the wow moments that when somebody's exploring, they're like, man, this is really cool. I need to dig in deeper with this.
Yeah, I think you're not wrong. I think a large percentage of wirehouse advisors, because that's what they're being told by their firms, have a misconception that there's a lack of fill in the blank, outside of the wirehouse. And it's the opposite. There's more of fill in the blank outside of the wirehouses, right? Because if you think about it, like wirehouses are RIAs, right? They're not any different than any, they're RIAs and they operate on custody platforms, some of which they own, some of which they outsource to. So, the light bulb moment for me and for a lot of advisors is when I was leaving Wells, thinking like, oh, Wells has everything and I'm going to take a step back. And then you go to these custodial partners and you look at what, you know, the Fidelity, Schwab's, Goldman's, LPL's, Raymond James of the world have to offer. I mean, it's everything and anything. I mean, if you think about what an average individual investor has access to when they open their own personal Schwab account, I'd argue they have more access. That individual 50,000 account, client has more access as a direct Schwab, Fidelity investor than most advisors have, at the big wires. So you just have so much access to so many different platforms. So it's not this box, it's custom curated by your wirehouse. You custom curate your own box. Really the challenge, I think, is how much time and effort and work it goes into shifting through the plethora of options out there. It's almost that's most people are excited about it, but they don't realize the other side of that coin is that then it's kind of incumbent upon you when it's not just given to you on a menu sheet that you've got to go create your own menu, right? And that means you've got to go out and look at all the different technology solutions, all the different investment options that are out there. So it takes some effort, and I think that's where a lot of times firms like ours come into play is we can help those advisors more effectively custom curate their own menu, without having to do it from scratch or reinvent the wheel. The ultra high net worth space is it's not even a debate in my mind. Like, I mean, if you look at where most of the family office or multifamily offices are out there, they are in the RIA space. The access you have to alternative private placement, very niche and bespoke type investments, you just can't get that in the cookie cutter wirehouse world. They're trying, but whatever you get in the wirehouse world is the watered down, commoditized, basically menu. What you can get in the RA space is so much more unique and differentiating. It's really once you start to dig in, it's not even really a comparison. It's just night and day difference.
Yeah, I mean the amount of flexibility in technology, investment offering, pricing. I mean, I'll just give the audience a real world example. Someone we're working with together right now with NewEdge. We're a $3 million team spending 35 basis points or charging additional 35 basis points to outsource their money management to their broker dealer. And literally by coming to NewEdge, same money management philosophy, same everything. I mean, they're literally putting $1 million of money back in their clients' pockets. I mean, talk about, advisors always ask what's in it for the client. I mean, that's just one real specific way that inside of a NewEdge, you can make true change to a client experience.
Oh, 100%. I mean, what do we always hear about? We're hearing fee compression, fee compression. That's it. But, so why are people still being charged and are paying 35, 40, 50, 75 basis points for asset management? That, in my mind, is absurd.
Yeah.
Now, we don't see fees actually coming down, right? So the average fee is still in that 1% range for, your typical 1 to 5 million type, household range, and the average fee on the other sides are, kind of staying the same. You have to do more to justify that fee, right? So it's margin compression, not fee compression. You really have to be able to offer cutting edge technology, tax planning services, true holistic advice, estate analysis, real, more true, comprehensive wealth management doesn't mean what it meant 10 years ago, which meant I'm no longer charging commission, I'm charging a fee. It actually means like providing comprehensive wealth management. And yeah, the asset management piece, I mean, it's often it's a win-win, right? Because if advisors having to charge their client, think about 1.35, right? 35 basis points going to the manager, and then the advisor is paid 50% of the 1%, right? They can go to this world right? And now basically cut out the 35 basis points, get the same type of asset management, oftentimes the same manager, and now they can drop their client's fee from 1.35 down to 1.1, 1.2, whatever they want. So the client's getting a meaningful discount, and the advisor is getting an increase in the percentage that they're sharing from the client's fee too. So it's a win-win for both, and it's not pennies. It's, as you mentioned, it's significant dollars for everybody.
For sure. I mean, another person we've worked with recently, UBS financial advisor owed, $2 million on his note still. Looked at a bunch of different options, and basically his choices were, not take a lot of upfront money up front to go to an RIA like a NewEdge, or, take a big deal from an independent broker dealer to unlock himself from that firm. Loved everything about NewEdge, couldn't make the economics work. And he said, Corey, I don't want to take a $2 million deal to unlock myself from UBS, then pay, 30% plus ordinary income on that deal. And I mean, you came up with a lending solution to be able to help him, unlock from that loan tax free. Yeah, it has an interest rate, but just a way more tax efficient way for him to be able to break free and launch RIA. I don't know if that would have been able to happen a couple years ago.
Yeah, no, I mean, I think, us and some of our other competitors too. I mean, we're able to be more creative, but I mean, our goal is to help entrepreneurial, you know, successful advisors, kind of regain the passion and the fun of what it is to be a financial advisor while simultaneously, um, you know, having the ability to kind of custom curate and do what's best for the client and all those things. And the, what I've learned, trust me, like this is a for-profit industry. Like don't let anybody try to tell you that it's not, right?
Yeah.
Every business, including ours, is. And if you take that approach, upfront money is not free money, right? It's coming out of somewhere, and it's 9 out of 10 times coming out of the advisor's pocket, right? And so, if you look at multiples and where everything is, like far better for an advisor to maintain more of that profit themselves, longer term than trade it for a short term ordinary income loan. So I mean, I tell people all the time, if you really want a massive upfront loan, I mean, I'll pay 30% less, just like the wirehouses will. Is that really what you want? And nobody ever takes up on it because that's just not what it is. And once you start to kind of unravel and understand, you know, where the money flows and who really benefits from it, advisors understand that. There are the scenarios where they have to unlock, right? So then for the people that don't want the big upfront money, but they got to pay something back or do something, that's where we can get really creative and come into a solution that gives them what they need to get to where they want to be without basically putting them frying pan to fire kind of scenario.
Hey, breaking in real quick. I really hope you're enjoying this episode and finding my YouTube channel of value. If you're a high performing financial advisor that can use somebody as a guide or a resource to explore all your transition options out there in the marketplace, I'm a non-biased, independent transition consultant that can help make this process so much easier for you. And another plus, it costs absolutely nothing to work with me. If you want to have a conversation, please feel free to text, call, email, DM me. My contact information is all over this episode, and I'll let you get back to it. So we talked about it in the beginning of the podcast, more options out there every single day. What do you think financial advisors should either be asking themselves or considering when they're choosing from the hundreds of different RIA options out there?
It's a good question. I think, the what I think is happening is kind of we're talking about earlier about how the wirehouses of old were pretty good places to work and build a career. If you think pre-08, right, you had 30 or 40 regional, they called them regional broker dealers back in the day, but regional firms that no longer exist, right? I mean, you had Smith Barney, Prudential, A.G. Edwards, Morgan Keegan, Merrill Lynch wasn't Bank of America, it was Merrill Lynch. I mean, you had all these options, right? And by and large, advisors were able to find a firm that kind of checked all of their boxes, right? So, and usually when advisors were moving from firms pre-08, oftentimes it was more local level issue or whatever. It wasn't, so you could find a firm that you really liked to be with, and advisors stayed with firms 20, 30 plus years. That all went away. So I think what you're seeing is kind of the reemergence of these regional broker-dealer firms through the RIA space, right? So firms like ours are really kind of laser focused on a very niche select group of advisors, that we feel like is our kind of down the fairway type advisor. That means every advisor isn't right for us, and we're not right for every advisor. So my point is that you can kind of have your cake and eat it too again, right? So whatever you're looking for, look for it because it's out there, right? Like if you're looking for XYZ resources, there are firms that specialize in those, and you can go find that firm with those type of resources and the culture and the philosophy and the payout and the support structure that you want. So my point is don't underestimate the amount of optionality, and don't sacrifice everything you want for a firm. The other thing I would say is don't be sold by the sale either, right? Like everybody's the best, right? We're all the best, whatever. Yeah, and there's a lot of really good salespeople in our business too. So, culture is really important, but the salesperson obviously oftentimes isn't who is running the company. It's not what the company is about. So, and even if you have a good relationship with the person running the company, there's a lot of really good executives or people that have gone out to try to start firms that maybe don't actually have the best firm and the resources in their firm. So just dig down. Don't be, I don't want to call it trick, but don't just join a firm because you really like a human that's at that firm, right? Like make sure that human and the things that are attached, that you like about that human also are real at the firm. And the resources and the things that you need are there. So those would be my 2 points is you can have everything you want. And because of that, don't just join a place because you have a relationship with somebody that you like or that you like somebody. You can have both. You can have everything you need and like the people that you work with.
That's awesome. That's super helpful. So I think we talked about this a little bit before, just kind of talking about all the tools and resources that you have in NewEdge. But in the independent broker dealer space, it's becoming pretty clear that size and scale is pretty important to continue to remain competitive. How do you think about that on the RIA side? Equally as important?
It's becoming more important. There's different reasons for size and scale. I mean, I think in the broker dealer world, size and scale is important because of the regulatory costs and the technology costs that go into building and supporting that. It's much more economically efficient to run an RIA. So there are different reasons for size and scale. So it's almost like from a profitability, sustainability, long-term reason. I mean, there's a reason LPL is so dominant in that space is because they're able to be incredibly competitive in their broker dealer offering, given their size and scale. On the RIA side, the size and scale thing matters, but it matters more for, I think, what I would call like the additive, non-commoditized side of an RIA. Like compliance is no longer, that's table stakes. If you don't have a good compliance department, that's, you're not even in the game. It's adding all these other things, the investment solutions, ultra high net worth solutions, tax, estate, marketing, all these other things that are really, they are expensive to support and build and scale. So that's what you're looking for. I think you're also, another thing to think about, maybe I want unless you want to go into this at this point is in the M&A space, right? There's two types of firms out there. There's a firm that's going to be acquired, and then there's a firm that's going to acquire them, right? Most of the firms out there are going to get acquired, right? So, I mean, you just saw what happened with Commonwealth, right? So, and that was a pretty big firm, a little different. But in the RA space, you see a lot of the names out there. There's not going to be 500 platforms in the next 15 years. There's
Yeah.
going to be 30 or 40,
Yeah.
right? So in our mind, getting big was meaning we wanted to get as big and as large as we could so that we could preserve who we are and be one of those 30 or 40 firms that exist 50, 60, 70 years from now, so we can protect our culture, protect who we are. If you're not big enough to be that, you're going to get acquired, and everything that you are, your culture and all that is going to get kind of wiped out and absorbed by whoever's acquiring you. So, if you're thinking about joining this, really great company that you like, and the leadership's got all these visions and promises, for the future. Well, if you're only 5, 10, 12, 15 billion, they better have a really good path to get to 100 or more in short order. Otherwise, whatever the name on the company is and the leadership of that company is more than likely going to be somebody else's leadership and somebody else's name, the next 5 to 10 years.
Yeah, and I think that's a great thing to consider. I mean, more than ever, I'm talking with IARs of RIAs that are, looking to break away, and that's one of the main reasons. I mean, it's somebody was an associate at a $3 billion RIA. That RIA wound up selling. All of a sudden, this advisor needs to make a really fast decision and sign a non-compete and sell with the rest of its firm, or make a move to a NewEdge type of firm or other. So with inside of all of this M&A, there's firms that are getting swallowed up where advisors are potentially losing ownership, or maybe they had a more flexible compliance environment where they can really express themselves and do what they want for clients. And then they're swallowed up into, a $90 billion RIA that's kind of, maybe a little bit more like a wirehouse now, and they're looking. So it's extremely important to choose which RIA you're a part of. They are not all created equal.
No, they're not. But I do think, like, if you're looking at leaving and joining one of these that are, you know, aspirational, you just have, there's aspirations for valuations, right? And, a $10 billion RIA is a very valuable RIA,
Yeah.
no doubt. But who's valuable to who, right? Who's ultimately going to be the acquirer of that firm? That's what you need to be asking. Because if it's a firm that's most likely to get acquired by a strategic or another firm, then everything you like about that firm may not be there, in the next turn. If they're valuable or they're big enough where they're probably too big to get acquired or rolled in to somebody else, then, you probably have a good amount of comfort to know that what you're joining is going to be there long term. And like you said, 100 billion feeling like a wire. I mean, it's still, I think we're in the infant innings of where this story goes. 100 billion, 300 billion, $500 billion firm still can be really small and boutique for the advisors. If you think about, again, those pre-08 firms, Morgan Keegan's, the Edge Edwards, 3,000, 7,000 advisors, half of, 500 billion of that. I mean, really big firms.
Yeah.
So there's a lot of runway to go. It's just, I would be very careful not to join a firm that isn't on its path to be one of the 30 or 40 survivors. Unless you're selling to retire and you don't really care, but that's a different, objective.
Let's talk about that for a second. I mean, there is so much buzz in the street right now where, advisors could potentially join a roll-up firm that plans to sell in 10 years and, sell a very small portion of your business now to get the ability to, sell more of your business down the road at the at the multiple that the parent company, sells at. I mean, what do you think of these roll-up models that are out there right now?
Um, I'll tell you from being on the buyer side, we've seen a lot of those firms come across our desk from, interested, investment banks and all those things. And there is not as much appetite as people think out there. And I think ultimately, like you have to, like, what is the end goal for these roll-ups? Like, some of them, it's, people are buying minority stakes in businesses, and it's just a big, if it, what makes these companies valuable is there's a story and something that makes sense for all these things to be together, right? So just because you bought 10 or 20% of 400 RIAs that are doing their own thing around the company doesn't make you a company. It makes you a minority investor or owner in 400 companies, right? So, you know, who is the ultimate buyer of that? What is the valuation for that? It's not going to be the same multiple as a firm that has a real story and a real reason for these companies all being, advisors being together. Um, so I think it's a little bit of smoke and mirrors. And I think, the owners and the people that are buying that 10, 20%, are just going to do really well on a cash flow basis because their promise is higher multiples later. I'll pay you a lower multiple today. Well, paying you a lower multiple today. So I'm going to, the people that are paying that are doing okay. Trust me. Um, again, I think ultimately they're going to have, if they are PE back, they're going to have to make some decision to bring these things together. And all these, I think there's a big misnomer. Minority investment does not mean minority control, right? That's where people, oh, I want to sell 10%. So no, you can own 60% of your business and have 0% control of your company. It's all about the deal, the restrictive covenants, the board structure. I would say almost all of those companies that do that, they don't have as much control as they think, and they're going to wake up one day being told to do something they may not necessarily want to do, and maybe not as much money as they thought that they were going to get. But
Sure.
again, I would also add this: if you're doing a deal for your financial practice exclusively for the equity future of your business, like we tend to walk away from those advisors anyway. Like I want advisors joining or going to a firm, whether it's ours or another firm, because it's first and foremost something really good for their clients and for them to be able to build. And, if you do that and you join a firm like that, then the equity should kind of take care of itself. If you're just doing something for some type of like financial engineering equity play, you know, we're not the first industry to try that. And we won't be the last industry to fail at it either.
Yeah, I think it's important for advisors to understand that, not all equity is created equal too. If it's a small startup, like you said, just small minority owner in 200 firms versus, a real company that has multiple silos of profitability that's continually growing. I mean, that's going to be such a different multiple at the end of the day than just piling a bunch of financial advisors together.
100%. But again, almost like the equity value and should be like the last piece of
Yeah.
the analysis. It should be first, like, what is this firm going to do for me and my clients? And if it's going to do something really valuable for you and your clients, then the equity is probably pretty valuable of that current firm, right? If it's just an equity role play, then, how valuable is it really, right? I don't, you know, I, we haven't really seen that tested um, in market yet, but I'll be very curious to see how it works. I wouldn't invest in it.
What's next for New Edge?
And we are just, it's really the evolution of the company, just as it's been, I mean, look, it's a blessing doing what we do. And, Rob, a kind of co-managing partner of New Edge, and I just kind of almost, it's almost funny, or just how what it's become, and really what we've become through this, right? We were both financial advisors. That's how we started this. And then we started a company, to really kind of help financial advisors. And we've both evolved into, I would argue, executives at financial, advisor firms now. And I think what's next for us is probably what's next for the other 20 or 30 real platforms out there, is just that next evolution from kind of startup-y, really boutique-y, you know, fragmented technology into a much more professional, firm feel uh, organizations that have really high-class technology, resources, support, personnel. The M&A space continues to be, a story for everybody. And if you're not in it, you're kind of not even playing in the game at the moment. But I think it's just watching us go from like when we were, you know, arguably a startup to a small company to, 100 billion sounds like big right now, but that's not really big. 3 or 5 years from now, it's going to be 500, and you're just going to continue to see this grow and evolve in a serious way. And I think it's the realignment and it's not like something new's happening. It's just you had this happen pre-08. There was 30, 40 firms out there. It just took 20 some odd years for the financial crisis impact to kind of reshake out and reemerge where it is today. And I think you're going to see firms that are going to be around for 100 years. They're going to be coming out of this channel, and that's our goal and objective. And it's just an honor to kind of be a part of
I love
that
it.
story.
It's really exciting to see. I forgot to ask you what's new on the New Edge Wealth side.
Yeah, uh, and they are crushing it. Again, kind of going back to what you can do for ultra high net worth clients in this space is just so much more differentiating and helping, and it helps advisors at NewEdge Wealth win clients. I mean, their win rate is crazy relative to when they're going against people from wirehouses or other places. But they're continuing to add intellectual capital resources. They're getting, because of the size and scale of the firm, the amount of really boutique private type investments that you'd never get at a wirehouse that are coming to us from venture capital, from private placements, from other PE firms, continues to increase. And they're building a really well-known national brand that, if you've got 50 million or more under management, I mean, I think you'd be, I'd put them up against anybody, in the space from what they can do for you. So they're going to continue to win in that space. And you're starting to see kind of some cracks in the armor of the other quote unquote ultra firms, I think, promising all this that, maybe didn't deliver. And what's great about New Edge is they're so laser focused on that ultra. They're not trying to be everything for everybody. They really are selective about the types of advisors and the end clients those advisors support.
Yeah.
That allows them to really deliver deep resources that, I don't care if you're your own $5 billion RIA, you can't afford, what a 20, 30, $40 billion organization is able to deliver, but still in a very boutique way. So continue to look at them to win these corner office wirehouse teams. And I think, really winning some of the bigger ultra teams from some of these other platforms that, promised them but tried to be too many things or too many different advisors. And now they're saying, I got to go to a place that really knows who I am and is solely focused on me and my, type of clients.
I love it. I had an advisor that made a move to New Edge Advisors a couple years ago, got in front of $100 million opportunity, said, Corey, this is like so out of my range. And he worked with New Edge Wealth, and they brought in, the people that client wanted to look at, and I think is really, really close to winning the business. So
Yeah, I think I know that client. So we call it our bridge program, and similar to our industry, private equity is everywhere right now. So you're seeing advisors that traditionally focused on the 2 to 10 coming across, having their existing $5 million client becoming 50, $100 million opportunities. Think about your local, dentist client that sells their practice to a private equity dental roll up or whatever industry you're in. um, and the capabilities and the products and the resources you need to win and compete for those 50, $100 million opportunities is just different, right? And most, I don't care if you got 500 or billion under management, if you're focused on 2 to 10, you probably don't have what somebody focused on 50 and up has. And to be able to work with them, sit on the same side of the table as NewEdge Wealth and win that business is awesome. And we've actually had some advisors that um, have realized that that opportunity is so much bigger now that they've joined NewEdge Wealth. They didn't think they were maybe they had enough opportunity, but once they got familiar and comfortable, they actually joined NewEdge Wealth's team fully and are now just exclusively kind of focused on winning that business. And it's been, that's not for everybody. A lot of advisors are happy
Yeah.
where they are and want to stay where they are. But if you are evolving or think you need to move that's been a fun thing to see occur across the firm.
I love it, man. There's a lot of tools in your arsenal to help advisors. It's always been a great experience working with you guys, and I looking forward to getting an update again in another year to see what's new.
Yeah, likewise. Congrats on all your success too, and helping a lot of these advisors weed through the noise because there's a lot of noise out there, and working with somebody like you that can actually help them distill down between steak versus sizzle is really important. And we appreciate what you're doing, not just for us, but for the advisors you help.
I really appreciate it, Alex. Thanks for your time. I hope you have an awesome day, and looking forward to talking again soon.
Yeah, likewise.